Hey everyone, so today I will be reporting about credit cards and consumer loans. So, credit card accounts. Credit card account is credit card is a thin regular piece of plastic or metal issued by a bank or any financial services. It allows cardholders to borrow funds which to pay for goods and services. So like for example, you're doing groceries or even doing some shopping from department stores. So credit card imposes the conditions that cardholders pay back the borrowed money plus any applicable interest as well as additional agreed upon charges. It is either in full by the billing date or over time. So the photo below shows the parts of a credit card. So the front part of the credit card has a chip, the card number, the expiration date, and your cardholder name. Then at the back is the magnetic strip, the owner's signature, a hologram, and a CVC code. So understanding credit cards. Credit cards are typically charged in a higher annual percentage rate or APR versus other forms of consumer loans. Interest charges on any unpaid balances charged to the card are typically imposed approximately 1 month after a purchase is made. So except in case where there is a 0% APR. Introductory offer in a place for initial period of time after account opening. So unless previous unpaid balances had been carried forward from a previous month, in which case there is no grace period grant for new charges. So a grace period is the period of time in which is given after the payment is due but before late fees, interest, or other penalties starts to accrue. So grace period is I think it's 21 days usually. Then after that, if you can pay the bills, then interest and other penalties will accrue. Next, types of credit card issues in the Philippines. So the first one is the standard credit card. So standard credit card are are as standard as they come. You're more likely to get a standard credit card as your first card since they are the most common. It is ideal for beginners and low-income earners, thanks to its lower credit limit and lower annual fees. Standard credit card also comes with a basic rewards program coupled with a highest interest up to 3%. So usually beginners, when a particular bank offers them a credit card, it usually starts at 3,000 credit limit. So if you are a starter and a new employee, so you can avail this standard credit card for you not to pay a higher interest. So next is the premium credit card. Premium credit cards, on the other hand, have more bells and whistles than the standard credit card. A premium credit card comes with added perks and exclusive privileges, so it can get you access to concerts, events, or private lounges at airports. It also has a higher credit limit and lower interest rates to encourage more spending. So usually people that uses these premium credit cards are those who are people who get high income or on big spenders. So usually a, a businessman or a celebrity. So usually their credit limit reaches up to millions or even billions. It depends. So next is secured credit card. Secured credit cards are easier to get since it doesn't involve a background check on a ton of documents. So in this secured credit card, they only need you to have a, what do you call that? Mm, uh, they only need you to have a collateral, which is a deposit account in their company. So if you have an unpaid balance on your secured credit deposit, you will receive a lower credit limit. That is why the banks often offers this type of credit card. So usually people using this has a savings on that certain company. Next is unsecured credit card. Most banks in the Philippines offers unsecured credit cards that requires extensive background checks and specific documents too. So to apply for one, you need to prove that you have a steady source of income. So in here, a lot of questionings and background checks will be done to a certain applicant. So the issuing bank will then assess your credit limit based on your occupations, income, and credit history. So if if you have a income with at least above minimum, then you can have a credit limit bigger than the usual 3,000. Then the higher your credit limit will be, providing you with enough spending power to afford high ticket purchases. So managing credit card wisely. So it is a 5 tips to use your credit card wisely and steer clear of debt. So first, spend with it within your means. The best way to avoid credit card debt is to pay your balance in full each month. In order to reach this goal, make sure you're only spending within your means. So if you spend, make sure that those things that are very useful to you, so that you can avoid a big amount of debt. Next is make monthly payments on time. So for you not to be or not to have a bad record, so you need to pay your bills on time. Next is keep a low utilization ratio. Ideally, you want to pay your balance in full each month. But if that's not possible, try to keep a low utilization ratio. Your utilization ratio is the percentage of credit current in use. Let's say you have a credit line of 5,000. If you have 2,500 in purchases on your card at a given time, you have a spend percent utilization ratio. So next is understand your credit card terms. So different banks, different financial businesses has a different terms and conditions. So knowing the specifics of your credit card agreement can help you to avoid unexpected fees and keep track of your payments. Different cards will be have different interest and potential fees, as I've said earlier. So next is don't open too many accounts in short period of time. There are lots of credit cards with attractive terms and features, but opening too many lines of credit cards at once will give you more places to accumulate debt. So let's say if BPI offers you a credit card, then after a few weeks, you have read that the credit card of the BDO is has a better interest rates than BPI, then you'll get the other credit card from the BDO. So avoid doing that. Understanding consumer installment loans. So what is an installment loan? An installment loan provides a borrower with a fixed amount of money, must be paid regularly, scheduled payments. So each payment on installment debt includes your payment of a portion of principal amount borrowed and also the payment of interest on debt. So like for example, a certain financial business offer you a 50,000, let's say, and you need to pay it on within 5 months. So you need to pay that 50,000 as the principal amount plus the interest payments using installment. So not in one time. So applying for an installment loan. A borrower applies for an installment loan by filing out an application within a lender. So usually specifying the purpose of the loan, such as the purchase of a car. The lender discussed with the borrower various options regarding issues such as down payment, the term of loans, and the payment schedule and the payment amount. So usually in, like for the example, purchasing a car, so you need to have a down payment. So you will lend money from the lender, then you, the lender will discuss the terms and the conditions on how you'll be paying that and how long you will be paying it. So advantage and disadvantages. Installment loans are flexible, can easily be tailored by the borrower's specific needs in terms of the loan's amount and the length of time that best matches the borrower's ability to repay it. These loans let the borrower obtain financing at a substantially lower interest rate than what is usually available within revolving credit financing such as credit cards. So this way the borrower can keep more on cash hand to use for other purposes rather than making a large cash outlay. So pros. So first is ability to finance a big purchases. So usually if you have a, let's say you have a credit card and you have a credit limit of 50,000, so you are planning to buy a some something that costs way too much than your cash. So it is much easier for you to buy that or to purchase that thing using your credit card. So next is payment amount typically stays with same throughout loan term. So yeah, it's, as I've said earlier, payment usually begins after a month of purchasing, then at least you need to pay it for minimum of 3 months usually. So next, usually possible to save interest charges by paying off loan early. So the so it is a, if you can save a lower interest if you pay your bills earlier than the said date. So cons, so it is the negative side. Loan fees can be high. So yeah, some loans, if you have loan, the fees are very high. It depends on the interest. It depends on what financial business you are in. Next is credit can be damaged due to late or missed payments. So if you missed or late payments, then your credit may have a damage. Maybe it can be recorded on your credit account or your credit card. Next is potential to borrow more than you needed. So diri ang part, tahay gioperan kanila og 50,000 pero ang imong need is 25,000 ra. So mura kag natintal og mukuha ba ka or di, kay palamian yung kanila og offer samot na og kwarta ang sigutan. So calculating the interest on consumer loan. So divide your interest rate by the number of payments you'll make in the year. So interest rate are expressed usually, not usually, annually. So for example, if you making monthly payments, divide it by 12, multiply it by the balance of your loan, which for the first payment will be your whole principal amount. So for example, on a personal loan of 30,000 over a period of 6 years at 8.40 PA and making monthly prepayments. So it goes like this: 0.084 divided by the 12 times 30,000 is equals to 210. Because you have now begun to pay of your principal to work out with the interest you pay in the following months, you need to first calculate your new balance. So principal minus repayment minus interest is equals to new balance. So minus the interest you just calculated from the amount you repaid. This gives you the amount that you have paid of the loan principal. Next, take this amount away from the original principal to find the new balance of your loan. To work out ongoing interest payments, the easiest way is to break it up into a table. So using the above examples, your calculation might look like this. So in the picture shows it is a on the first month, your starting balance is 30,000, then repayment is 532, interest paid is 210, principal paid 322. So your new balance now is 29678. So after that, then you start after the first month, then there comes the second month of payment. So your new balance 29,678 minus the principal paid of 324.25 cents. It equals to 29,353 and 75 cents. So on and so forth. So until your fifth month, which your new balance is 28,367 and 31 cents. So that would be all my report, and the next reporter will be Mark Christian Akasio.